Hello and welcome to Looking at the Markets with David Modell, the moving average ribbon. Maybe you never heard of this. Maybe I'm introducing something to you that could change how you trade and invest. I think it's really valuable to have an arsenal, a toolbox of strategies and indicators. That way you can have advantages over most other traders out there. This one is called the moving average ribbon, and it kind of looks like a ribbon, so it's a great name for it. And it involves 4 moving averages, at least on TradingView it does. Now I'm using tradingview.com, okay? So if you want to use the moving average ribbon, you would go to indicators, and then you would just type in ribbon, easy enough, right? And then go to moving average ribbon, and it will put up the 4 moving averages. Now, if you're on a trading platform that does not have moving average ribbon, no problem. Hopefully, you can set up 4 moving averages just manually. Just do it yourself one at a time. So what is it? Well, you put up, these are all SMAs, by the way, simple moving averages. You put up the 20, simple moving average, the 50, the 100, and the 200. I'll repeat that. 20, 50, 100, and 200, period, simple moving averages. Can you do this with EMA, exponential moving averages instead? Sure, why not, okay? Try it on your own. I'm just using the default settings here on TradingView. Okay, so you can see which ones are more reactive, which ones move faster, and which ones move slower. Well, as you can see on here, the 200-day moving average here in red, it is the least reactive. In other words, it reacts quicker to the price movements. It reacts slower, I should say. The 200 period moving average reacts the slowest to how the candles are moving, okay? So the candles go down fast, but the 200 SMA could still be going up, all right, because it's reacting to the last 200 candles or periods, okay? Then the 100 period SMA, simple moving average in orange here, it's a little bit more reactive, reacts a little faster. And then you got the 50, which is in brighter orange, and then the 20 SMA, which reacts pretty quickly, okay? So as you can see, the candles go down, the 20 goes down with it, okay? It's the fastest reacting one. And therefore, the 20 in yellow here, bright yellow, it clings to the candles pretty closely, right? I mean, watch that yellow line as I move, right? Okay, you see how it's kind of staying close to the candles here, as opposed to the 200, which is farthest away oftentimes, typically from the candles out of these 4 moving averages, all right? So it kind of looks like a ribbon, sort of, so I think it's a good name for it. But you can put those up manually. What's good about doing it manually is that you can pick and choose the ones you like the best. It doesn't have to be 20, 50, 100, and 200, all right? You can pick your own numbers. You can combine SMAs and EMAs, simple and exponential moving averages, whatever you like. So what are some little strategies or tips you can use with these? Well, the most obvious tip for me is that I would probably consider only buying a stock, and I'm using Apple stock, daily candlestick chart here. Each one of these candles represents 1 day of price action in Apple stock, but you can use this for 1-minute candles, 5-minute candles, hourly candles, daily candles, whatever you like, all right? So one concept that's really evident to me is I would probably only go long, meaning only buy, Apple stock when the candles are above this red line, the 200 period moving average. In this case, it's a 200-day moving average since these are daily candles, all right? Because what happens if you don't follow that rule? Well, here are the candles going below the 200, and look what happens. Just down, down, down. Lower highs, lower lows, oh my, right? Okay, so real problems can occur when you take a long trade, when you buy below that line, okay? Not always. I mean, there are exceptions. But notice that when it's above, you know, you can get some really nice bounces. Here it went below, you stay out of the trade, but now it's back above, so you can get back in the trade for some nice profits in this case. Doesn't always work out, okay? There are no guarantees that any of this will work. You have to make your own decisions, do your own due diligence, okay? And don't try this out with real money. Try it out with virtual or demo trading with no actual money, just to make sure these things work. Another concept is perhaps don't get into the trade, especially the long side of the trade, the buyer side, until all four moving averages are moving in the same direction and separate from each other. Okay, it's not a jumbled mess, right? You see how they're in the right order, in other words. You know, the 200 on the bottom, and then the 100, and then the 50, and then the 20 on top. Okay, it's in the right order, and that's a definite uptrend right there. If they're all in the right order and moving in the right direction, then you can buy with confidence, at least at the moment, that the trend is to the upside. Okay, and then if you're going short, maybe wait until all four of them are separate and trending downward. That's a possibility as well if you like to play the short side of things, which is risky though. Don't do that unless you know what you're doing, and always have some sort of exit strategy in case it goes against you, in case the trade goes against you. Okay, so like I'll show you an example. Like, this is pretty clear cut, but I'll show you what a jumbled mess might look like. Right, this is kind of messy here. You know, now here's another example. See, they're all going in the same direction. There's separation between them, and it's in the right order. The 20, the 100, the 50, I'm sorry, the 200, the 100, the 50, and the 20 period moving averages. And so clear uptrend right there. Okay, like here's a jumbled mess right here. What do you do with this, right? It's choppy, it's just messy, okay? So that's another possibility. Another possibility is to, again, assuming that you only buy when the candles are above the 200 period moving average, then you could pick your favorite moving average crossover above that. And so let's say, I'm going to get in when the, let's say the 20, which is the fastest moving one in bright yellow here, when it crosses above the 50, okay? So when the 20 crosses above the 50, which is the bright yellow crossing above the bright orange one over here, then you can get in, and then don't get out until it crosses below. Okay, till the 20 goes below the 50, or you can use a separate pair of moving averages for your exit strategy. Just because you use the 20 and the 50 crossover for the entry doesn't mean you have to use the 20 and the 50 cross below for the exit. You could use whatever, you could start getting this one involved, the 100 period moving average. Okay, maybe when the 20 crosses below the 100, all right, which in this case would have given you a tighter exit strategy than if you waited until it crossed back below the 50. These are just examples, okay? You can mix and match your crossovers and your cross belows for your entries and your exits, always staying above, only taking long trades when you're above the 200. That's a guideline. You don't have to use it. You don't have to use any of these. These are just concepts, okay? And so these are things to look for. Again, experiment with the numbers. Who says 20, 50, 100, and 200 have to be your numbers? Just because these are the defaults on a website, okay? So go to your platform, see if they have the ribbon moving average, okay? Again, you just type it in. Ribbon, moving average ribbon, they might call it, okay? Or make your own ribbon. And it could be with 3 instead of 4 lines on there, okay? So you decide, you pick, you choose, tailor it to your needs, because no one has the same needs and expectations that you have. So I hope that I introduced you to something different that you could give a try, just not with real money, okay? Virtual or demo trading only. Thanks a lot for watching and listening. Hey, I will talk to you again really soon.